live stream, there are problems brewing, folks, in the world and in the US economy. And when the sheer scale of these problems becomes apparent to investors at large, it will be too late to stack gold and silver. But luckily, we're not there yet. We're going to talk about those problems in today's video. If you'd like to stack some gold and silver before that time comes, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, let's get right into it today, folks. We have got the price of gold just shy of $2,000, the spot price coming back under 2,000 bucks today in trading, but I think it's just taking a breather, and we're going to see it take off in very short order. That's just my forecast, just how I see things. Now, let's talk about why. Here's something from the U.S. Treasury. Oh no, I have forgotten my notes. Give me 1 second. I gotta grab it. Okay, sorry about that, folks. So, we have got the U.S. Treasury today coming out and announcing their plans to borrow for the next several quarters. And let's see, it's a doozy, folks. It really is a doozy how much they plan on borrowing. Of course, they're trying to put a very rosy face on these things, but let's talk about the numbers. First, let's get the U.S. debt clock here just so you can be reminded of just how much borrowing has been done in your name if you're here in the U.S. like myself. So we just got done actually with a record Q3 in which the Treasury sold $1.01 trillion worth of debt. That was a record for quarter three. Now, they're planning on borrowing, they tell us, in the quarter that we're currently in, October to December of 2023, $776 billion. Now, that will be a record for the fourth quarter. So they're planning on borrowing a lot. However, in this press release that the Treasury put out, they mentioned that this is actually lower than what they had previously envisioned, previously forecast borrowing in the fourth quarter. But they neglect to mention that this will be a record for the fourth quarter. And at the same time, they've told us what they plan to borrow in quarter one of 2024. So January to March 2024, the Fed now planning to borrow $816 billion. I'm sorry, not the Fed, the Treasury planning to sell $816 billion worth of U.S. Treasuries, which will again be a record-setting quarter one. Now, the largest borrowing on record actually took place back in Q2 of 2020. They borrowed about $3 trillion then due to the pandemic and all of the stimulus and pandemic relief. But I have a sneaking suspicion that we may be taking that number out in very short order. And by the way, the $776 billion that they plan to borrow this quarter, the previous quarter four record sits at $689 billion. So outpacing that significantly. And that was in 2021 Q4, when again, they were spending a lot of money on COVID. So right now, ostensibly, it's quote unquote peacetime. Although, that's a bit of a joke to call these peacetime deficits. We're already involved in, proxy wars around the world. However, when those wars heat up and they break out in a big way, the peacetime deficits that we're running right now will pale in comparison. And we'll get into a brief Middle East update later on in the day. That's not really the focus of this video, though. I want to talk about the financial problems here in the U.S. So, yeah, they're borrowing record amounts of money, and therefore it is no surprise that the yield on U.S. Treasuries is absolutely exploding. Right now, the 10-year yield sitting at 4.875%. We'll be over 5% on that very soon, I would imagine. Keep in mind that right now we are still at the highest levels since 2007. Of course, that was immediately before one of the worst financial crises in history. But what we have coming up, by the way, is going to be a lot worse than 2007, 2008, folks, because all of the problems that existed then, they still exist. It's just they're a lot worse because they just got papered over back then. And there's going to be a lot of problems. That could be why we just saw Jamie Dimon, the CEO of JP Morgan, announcing that he's going to be selling shares of the bank that he's run for nearly 2 decades for the first time. He's been CEO for I think 18 years. He's going to be selling about a million shares, I think it's about $135 million worth of JP Morgan shares. Of course, he tells us it's just for tax planning and diversification purposes, but it's very interesting that the banks seem to be on the verge of a massive collapse, and Jamie Dimon here is for the first time in nearly 2 decades selling a significant portion of his shares. Now, why do you think this guy is selling his shares? Do you think it's because he needs the cash? What do you think it is? He wants to build an expansion on his house, wants to take the family on a vacation. I suspect that that is not the reason. I mean, this guy's worth about $1.7 billion, I think. So, I don't think he's selling these shares to pay for the groceries. I mean, I know the price of food is up. I know rent is up. I know the price of gas is up. But this guy is selling shares because, very likely, I mean, I'm not inside his head. I don't know what his motivation is, but I would anticipate it's because he knows the financial system in the U.S. is, on the verge of collapse. These banks are all insolvent. They're all sitting on a bunch of devalued, low yielding US treasuries that if they were to actually mark them to market, they would show that these banks are basically insolvent. JP Morgan, Wells Fargo, all these big banks, not to mention the hundreds of regional banks, which are very likely, insolvent at this point if you were to actually have to mark all of their assets to market. And it's very possible that should we get some kind of a troublesome event in the financial system, which is likely right around the corner, you could see depositors trying to pull out their money from these banks. And when that happens, well, we saw what happens in March, just this past March. Banks start to fail. They're forced to sell these assets and actually realize these losses. And it's not pretty, folks. It's not going to be pretty. So here's one from bankrate.com. Because we do have the Fed FOMC meeting this week. We have a very busy week, actually, in terms of financial data. So likely we'll see some significant movement in these markets this week. It's going to be a very interesting one. From Bankrate here, Fed meeting preview: will surging bond yields force the Fed to pause its interest rate hikes? And again, the yield on treasuries is absolutely exploding. Now, part of this is because the Fed has been raising their benchmark federal funds rate. In fact, that's kind of what the mainstream financial media wants to tell us. But here's the thing. A lot of this has to do with how much deficit spending there is. Again, I went over some of the numbers at the beginning of this live stream. The Treasury now telling us they're borrowing record amounts of money. Now, it's like they want to say it's a good thing because, hey, in quarter 3, the one we just wrapped up, we borrowed more than $1 trillion. So now all we're going to borrow in Q4 is $776 billion. Isn't that great, folks? And then Q1 of 2024 will be $816 billion. Of course, by Q1 of 2024, World War III probably will have popped off in earnest, and I imagine the borrowing will be significantly more than $816 billion, but who knows? Only time will tell. But that's a large part of why the yield on U.S. Treasuries has been surging. The U.S. 10-year yield has been on a run for 3 years straight. That hasn't happened since 1787, so think about that. And again, the rate climbing here to the highest level since 2007. Only thing different between now and 2007 is that there's a huge amount more leverage in the system. Plus, you have the problems with these banks sitting on all of these devaluing treasuries. Every time this goes up like 1%, a 10-year portfolio of 10-year bonds loses a huge amount of value. It's even worse for the longer term treasuries, the 30 years. They lose even more. Now, let's take a look at what the CME group and their FedWatch tool here tells us is going to happen at the Fed meeting. So you got Jamie Dimon, first of all, dumping shares at JP Morgan for the first time in 2 decades. Now, this is very interesting, though. Look at what the CME tool tells us markets are anticipating will occur at this FOMC meeting that's coming up November 1st. It's going to be wrapping up on November 1st. So it's going to be starting tomorrow, the 31st, and then wrapping up on November 1st. We're going to see what the Fed does. Now, it actually looks like there's a very strong consensus they're going to pause their rate hikes. There's actually a 5% consensus, though, that the Fed is going to begin cutting rates. I mean, that's pretty amazing, especially you look at this part here, what people were expecting a month ago on the 29th of September. There was an 18.3% chance of a hike, 81% chance of a pause. But now, look what has happened. Now there's nobody's saying they're going to hike. Nobody thinks the Fed's going to hike, and I doubt they will. I mean, the Fed is in the business of delivering what the market expects at this point, and I expect that this is exactly what we're going to see, a pause, more of a pause. Now, that's very interesting because, inflation continues to be a very serious problem. I don't need to tell you this, I'm sure. If you live in the US, you go shopping, you fill up your gas tank, you buy food, you know that inflation is still a very big problem. So, why is the Fed pausing? Well, I think it's probably because they know that these banks are on the verge of collapse and they can't withstand any more rate hikes. Do me a favor. We got 247 people in the chat in the live stream, 54 likes. Smash that like button for me. Help get this information out there if you would. And it's not just the soaring interest rates, which are putting a tremendous amount of pressure on these banks. We know that their portfolios of U.S. bonds are devaluing, but also you have to keep in mind, mortgages are moving up. The mortgage rate now is what, like 8%. Think of all the mortgages these banks took on when the rate was much lower. They work just like bonds. As the yields go up, the existing mortgages decline in value. And thank you very much, iReview, for that super chat, and for everybody who supports the channel this way. And we just got up to 80 likes. Thank you all so much. And I know there's a bunch of you listening who haven't liked it yet, so smash that like button. Do me a favor. All right. Here's one from, this is originally from Financial Review, and I believe there was a similar article posted in the Telegraph, but it's behind a paywall, and I don't have a subscription there, so we're going to look at this one. Hundreds of U.S. banks threatened by rising wave of property defaults. So the banks are under pressure from a variety of sources here. It's not just soaring treasury yields, although that does put a lot of pressure on these banks. But right now, the commercial real estate sector is in shambles. In COVID pandemic, I don't know if I can say that anymore. Hopefully the algorithm treats me kindly. I think that's not as big a deal anymore. But so the office space in the U.S. has really come under a tremendous amount of pressure. I mean, it's gotten nowhere near pre-COVID levels, the occupancy rates and the amount of traffic in these commercial real estate buildings, these office space. And we're going to get into a few numbers here from this article, but it's pretty shocking. And this is going to put a lot of pressure on the U.S. banks too. And we really haven't seen the other shoe drop in terms of this particular problem that is pressuring them. And I think that this has a lot to do with why Jerome Powell and the FOMC are still pausing. So from this article here, America's office stock has lost 40 to 45% of its pre-COVID value, courtesy of shrinking rents and the most aggressive monetary tightening of modern times. Office blocks purchased with debt remain half empty 18 months after the end of the pandemic. Thousands of buildings will have to be torn down. Hundreds of regional banks are sitting on crippling losses they have yet to acknowledge. This is Professor, unpronounceable name. I'm just going to show you the name on the screen there to show you what I'm working with here. Completely unpronounceable, so I'm not even going to try it. Hey, Constitutional Stacker. Oh, by the way, before I carry on with this, I did a live stream earlier tonight with Constitutional Stacker. It's about an hour and 20 minutes long, so if you feel like just listening to me and Constitutional Stacker ramble on for a long period of time, make sure you check that out and go give his channel a subscription. Thank you, sir. Appreciate the super chats. And then he went on to say, so he's a property and finance expert at Columbia University, this individual, Stigen, I guess, Van Nieuwerburg. Sorry, Professor. He also went on to say the return to the office isn't happening. Data from turnstile swipes shows that occupancy levels are still just 49% of where they used to be. So think about that. They're talking about people accessing this office space, and the occupancy based on that data, just hard data, how many people are walking in and out of the door, is at half of what it was pre-pandemic. So people don't want to go back to the office. Hybrid working, people working from the home, regardless of what CEOs and business owners want to do, it's here to stay. And I think that the pandemic revealed that maybe we had too much commercial real estate, but this is a huge problem because the banks have a tremendous amount of exposure to this. So average office rents have already dropped by 20%, yet 2/3 of the leases have not yet come up for renegotiation. That's the real problem. These leases, they were locked in for a while, but now, again, we're waiting for the other shoe yet to drop. The full exodus has yet to happen. $8.7 trillion of debt. The worst trouble is in office buildings, though prime assets and hotspots have avoided the broader bloodbath. Projects that made sense in the QE world of free money are no longer viable in the new world of 5% bond yields. Yeah, so I want to address that point real quick. This line here: projects that made sense in the QE world of free money, they're no longer viable. They didn't make any sense back then, folks, because it didn't make any sense for the Fed to be conducting QE because it leads to all of this moral hazard and malinvestment. It distorts the economy. And sure, everybody's living high on the hog while all the free money is flowing and the punch bowl is still available. But now that the Fed has taken that away, we're beginning to realize that that was all just an illusion. It's like, I mean, I've never used heroin, but we can use the analogy here. It's like when a junkie, heroin using individual gets high, yeah, it feels great. But afterwards, it's not good. Unless, of course, you get more heroin, which, I think that's probably what we're headed towards. In this analogy, that would mean more QE, more money printing. Pain, this is another quote: pain will be felt across the board. In the office space, we're already recapitalizing loans at 50 cents on the dollar. The equity is wiped out and half the loan wiped out, he said. That's if you can get a loan. Banks are being forced to slash exposure by shareholders, boards, and regulators. They're not actively lending anymore. They're only lending to their best customers. So credit is drying up. And bottom line, the commercial real estate sector is going to put a hurting on these banks, folks. And that is the result of printing all of this money and keeping interest rates artificially low. Like, oh, you mean free markets that regulate interest rates by a pool of savings and capital, and then lenders and borrowers get to determine the rate? That is what makes sense. Yes, that is what makes sense, Jerome Powell. But all of these Keynesian economists, they don't get it. They think that they know better than the free market. Now we're going to learn the hard way that that's not the case. So the Fed looks like they may be pausing. We may already be done with rate hikes, folks. Very likely, especially if this war pops off in a significant way. That's a great cover for them to begin easing again, if you ask me. But they're definitely at least toying with the idea of pausing. And very likely in 2 days, when we get the announcement for the FOMC, it is going to be a pause. Now, to put this into context for you, here is a chart from the FRED. This is provided by the Federal Reserve. A chart of the federal funds effective rate. And one thing you'll notice is that the Fed actually began their pausing back in 2006. And at this time, there were some problems. There were, obvious imbalances in the economy. That's why the Fed was pausing their rate hikes then. There was all this talk of a soft landing. Does that sound familiar? It certainly does to me, because that's all we hear about from the Fed. And I'm sure at the press conference at the FOMC, we're going to hear Powell talk about a soft landing again, about how strong the U.S. economy is, and all this nonsense. But that's not how things played out here. The last time they did this kind of pause back in 2006. In fact, they were forced to begin cutting in 2007. It was in September 2007, I believe, that they began cutting rates, because that was when the real estate bubble began to pop, and the Fed thought, well, we'll just save everything. But of course, that didn't work, that small rate cut they did in September. So they ended up, by the time, Lehman Brothers and everything was collapsing and it was a full-blown financial crisis, they slashed to zero, and they kept it there for a very long time. Now, the problem with doing that this time around is that the Fed is not even anywhere near done with their, quote-unquote inflation fight. Of course, it was doomed from the beginning, because the deficit spending in Washington almost ensures that the inflation will continue running much higher. But we're in for a repeat here, folks, because the only difference between 2007 and now is that all the problems from back then are that much worse. But look, the Fed has actually managed to get interest rates up to the same level they were back then. Now, keep in mind, the U.S. national debt back in 2007 was under $10 trillion. But where are we at today? $33.684 trillion. So the fact that they've even managed to get interest rates up this high is pretty shocking. And, the interest cost on the national debt now exceeds $1 trillion, which is pretty incredible. And again, the Treasury just told us today that they're going to be borrowing another $776 billion this quarter. Next quarter, it's going to be $816 billion. Keep in mind, it took more than 200 years to ring up the first $1 trillion in debt. And now we're talking about doing it on a nearly quarterly basis. In fact, the quarter that we just wrapped up was over $1 trillion of borrowing. George Hernandez in the chat here says, will never be paid back. Well, that's possible. I think it's more likely this debt actually will be paid back. But it's going to be paid back in dollars that don't have a lot of purchasing power. Now, it is true. I mean, there's no way to pay this back with dollars the way we have them now. So basically, the Treasury is going to have to either default and say, look, we don't have your money. We spent it all. That's why every couple months, we start hearing about government shutdowns and debt ceiling limits. It's because the government's broke, right? Um, but I think it's more likely that rather than a default, what we'll see is a default by another name, which is paying this back in, devalued paper script, which is where we're headed. Eventually things are going to get bad enough that the Fed is not only going to pause, but they're going to begin cutting the rates. And it's just a matter of, what event will trigger that. Will it be a collapse of the commercial real estate sector? Maybe. I mean, that's a real possibility. Will it be some black swan that, we can't even imagine? That's always possible. Certainly, it's not going to take much because the system is so fragile now that just about any black swan tail of risk event would likely drive the Fed to, you know, slash rates and fire up the printing presses. Could very well be a war. I mean, that's something we're right around the corner of. But, they're going to continue painting a good face on this thing until the very end. And that's why, you want to take advantage of the fact that silver is still like 23 bucks an ounce, despite the fact that all of this is happening. It's half the price it was in 1980. Gold is at 2,000 bucks, but back in 1980, following the massively inflationary decade of the 1970s, which we are about to top in terms of inflation, I think, moving forward, gold was about 850 bucks at the end of that bull market, which if you adjust it for inflation is over $3,000. So I mean, the metals are still very cheap by just about any standard, and yet, look, I said there's going to come a time when it's going to be too late to get into gold and silver. You know when that time is going to be? It's going to be when everybody wakes up to what's going on. And that is just around the corner. When they realize that the inflation fight was a joke from the beginning, when they realize the name of the game is massive devaluation, everybody's going to want this stuff. It hasn't happened yet. And we know that because the price remains extremely undervalued. So, look, I don't give financial advice on this channel, but I am going to continue stacking. One thing that I said in the recent pullback that we had in the price of gold and silver was that one thing that was sure is that looking back on that time, we would just have the regret that we didn't buy more. And I certainly have that regret. I mean, I did do some stacking when the price pulled back, but I sure wish I had done more because now the price is right back up where it was before that pullback started. But I think the same lesson applies for today's prices. Looking back from 5 years in the future, 10 years in the future, maybe 6 months in the future. I'm not really sure. I don't have a crystal ball. I can't time things, that accurately. But there is going to come a time in the future when I think we're going to look back at today and we're going to say, man, I wish I had stacked more. But this is the kind of stuff that they're going to keep telling you in the mainstream. U.S. GDP grew at 4.9% annual pace in the third quarter, better than expected. Look, they say this is driven by consumer spending, exports, residential investment, and government spending. Well, yeah, the government is certainly spending a lot. I don't necessarily know that that's particularly good for the economy, especially because ultimately all of that debt is going to have to be monetized by the Fed, and it's going to be massive inflation. Also, consumer spending. This is like the funny thing. They keep saying, "Look how strong the consumer is." Look how fast GDP is growing. But this is all inflation, folks. This is because they're underreporting the amount of inflation there is. So of course consumers are spending more. They're not getting more for their money, but they are spending more because everything is so much more expensive. So, that's how you get these ridiculous GDP numbers that everybody says is, GDP has a lot of problems as a metric anyway, but the light that they put this stuff in is just comical. It's like, hey, aren't we lucky that the U.S. consumer is running up record credit card debt to pay for necessities? That's so great for the GDP. I mean, absolutely insane. But it's very likely that in the very near future, days, weeks, possibly months, we're going to see an event which will cause the Fed to uh, begin running the printing presses again, and also which is going to drive the price of the commodities, including gold, silver, oil, much, much higher. And that has to do with this war that is playing out in the Middle East. Now, I told you that wasn't going to be the focus of this video, but I mean, look at this. Iran-backed forces have attacked U.S. positions and allies 23 times in the past 2 weeks, Pentagon says. This is a ticking time bomb, folks. The Middle East is on the verge of a conflict, the likes of which, we may not have seen in living memory. Um, I- this has the potential for nuclear weapons. I mean, the U.S. has two carrier strike groups and an amphibious ready group there. We've got 2,000 troops on 24-hour deployment readiness. And I want to read you something that some U.S. military officials have told us here. It's about Iran and the IRGC, that's the Islamic Revolutionary Guard Corps, who use infrastructure, militants, and proxies on the ground across the Middle East to include both Iraq and Syria. That's from the Defense Department. We reserve the right to respond at a time and place of our choosing, and we're going to continue to do so. So if you're looking for an event which could trigger a massive surge in the price of commodities, and it could trigger the Fed to begin running the printing presses again, look no further than our attack on the Iranians and the Iranian backed militias in Israel. Now, I'm not saying this is a guaranteed thing. It's really not going to be to anybody's benefit if this occurs. But, if you want to protect yourself from this kind of tail risk event, gold and silver is one way to do it. And, I mentioned this on the live stream with Constitutional Stacker earlier. It's not really about getting rich, because if the price of gold and silver take off, folks, it's not going to be a good sign for anybody's standard of living. But what it is about is not being impoverished while everybody else is. Because, if we see the dollar price of gold and silver taking off on this kind of an event, this is a very, very ominous sign, folks. But it's still one that we need to be aware of and a risk that very likely, could take place. We've got Israel rolling tanks into Gaza right now. And I know this is a very divisive issue, but listen, the divisiveness on this is just another sign that we need to be getting prepared. I mean, I haven't seen the people I know and just people in general society this divided at any time I can remember. It seemed like the presidential elections that we've had the past couple times around have been pretty divisive, but I mean this thing has got people divided on very fundamental levels, like religious levels. That's the kind of level that wars are fought over. There have been crusades, there have been campaigns based on religion many, many times throughout history, and it's crazy in 2023 to see that playing out again. But it does seem like that is going to have a significant impact on this conflict. And the fact that, society is so divided, it gives you an idea of how disruptive this conflict could be. Because, when you get into a war, you kind of want your society to be unified. But that's not the situation we find ourselves in. Everybody is very divided. Everybody seems to be playing into the hands of the powers that be, whose game plan is divide and conquer. And, you know, a lot of this is just a cover for wealth transfer, if you ask me. That's my take. The powers that be love to see people divided on things like religion and race and, political affiliations, because that way they can rob us all blind. It's a good cover when you want to devalue the currency and rob everybody through the inflation tax, the hidden inflation tax. Like look over here while I rob you blind. So listen, don't buy into the divisiveness. The name of the game is divide and conquer, and get prepared, folks, because the U.S. financial system, the regional banks, the big banks, even J.P. Morgan, the big ones, a lot of these banks are having a lot of problems on their balance sheets. It wouldn't surprise me. Now, this is just speculation, mind you, and sometimes it's okay to just speculate and kind of think about things out loud. But isn't it convenient that as we face a collapse of the financial system, that the elites who are in charge seem to be bringing us to war? And wouldn't it be a convenient excuse to begin running the printing presses again? Because here's the thing, when the Fed started QE back in 2008, back in 2020, they were touted as our saviors. Population's not going to buy that this time around. I mean, as brainwashed as people are and as clueless as they are about how the financial system works and about how inflation works, they know that the Fed has something to do with why their grocery bill has doubled. They know. So, in order for the Fed to, pull the printing press out of their magic bag of tricks, which literally is one trick, which is just print money, they name it a bunch of different things. But in order for them to do that, they're going to need something big. And if you want to know what that might be, just pay attention to what's going on in the Middle East. I hope I'm wrong about this, folks, and I hope that this speculation is just paranoia and errant thoughts, but it seems awfully convenient that as we head towards a massive financial collapse, we seem to be on the verge of war. Very convenient indeed for the folks in Washington and the folks at the Federal Reserve. But let me know what you think in the comments down below, and stay safe, everybody. Get prepared. I'll catch you next time. Smart Silver Stacker, out.